The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. I hope everyone had a great Memorial Day weekend and got to spend some time with their family and friends. Um, Today we will be having Baker Tilly present for us. Just a couple quick things before we do get started. If you can see the handouts page right there, there is 2 of 5 handouts. One of them is they're both the same exact file, just one is a PDF, one is a PowerPoint. So I just wanted everybody to be able to get what was easiest for them. If you have any questions throughout the webinar, you can go ahead and put those in the questions tab, and we will be going over all of those at the very end of the presentation. So now I just wanted to say thank you to Baker Tilly, one of our preferred and valued business partners, for being part of our Safe and Calm webinar series. Baker Tilly is a leading advisory, tax, and assurance firm dedicated to building long-lasting relationships and making differences for their clients. Their fundamental purpose is to enhance and protect their clients' value. The Baker Tilly team welcomes whatever opportunities and challenge their clients might face and work together to build proactive solutions that are long-lasting. Today's presenters will be Lori Horvath, who has more than 20 years of public accounting experience, including 12 years with an international firm with 5 in a national office role. As Baker Tilly's healthcare and not-for-profit practice leader in Detroit, she specializes in providing auditing, accounting, and consulting services to not-for-profit and healthcare, including financial statement audits and single audits under OMB uniform guidance. And Larry Moore, who is a tax partner in the Commercial Services Group, has been with Baker Tilly since 2007. Larry has public accounting experience since 1986. He is a valued business advisor who works closely with owners, investors, and executive management to develop and implement corporate strategies that enhance business growth. Now, I think that is everything that I needed to take care of, so I will turn it over to you two. Thank you.
Thanks, Blake. I'll
Thank
go
you
ahead
very
and kick it off. Thanks everyone for joining us today. It's interesting to present in this virtual role. My favorite part of our partnership with Leading Age is seeing old friends and clients and different people we've come to know through the years. So just seeing numbers parade across the screen is a different dynamic, but certainly our contact information is on the slide you're seeing right now. And I just want to introduce my partner, Larry Moore. Larry, as Blake said, is a super smart client service partner, but he's also proven himself to be one of our firm PPP experts during this process and during our learning and understanding about the CARES Act and all the different funding. So we're thrilled to have him present to the Leading Age Michigan audience today. And I'll provide some color commentary, but kick it off to him. Thanks, Larry.
Thank you very much, Lori. I really appreciate it with the over-the-top introduction. Always happy to have that. Yeah, so today's objective is primarily to go over and look at the multiple programs that are available to help during the pandemic. And then also the other thing to do is what should your organization be doing now? The key thing today is because of the release of the Paycheck Protection Program application form last week, we're going to spend a bit of time just looking at that and looking at the updated guidance with respect to the PPP program, Paycheck Protection Program, and go through that some parts relatively quickly. So I'm hoping you have some background on both the PPP program and the EIDL program that we'll get into in just a little bit. And then we'll get into more depth with respect to with the application coming out. So without further ado, let's jump right into it. So as a reminder, the Paycheck Protection Program is a loan program, but the key component with it is that it's a forgivable loan program. The other thing with the Paycheck Protection Program is it does apply to small businesses, but it also applies to any organization that is tax exempt under 501c3 of the Internal Revenue Code, and then also C19s. We don't really need to touch on that too much. Whereas when you get into the economic injury disaster loan, it's a lot easier to say EIDL, it too applies to small businesses, but it's open to all tax exempt organizations that are exempt under 501c. So the difference is C3s are your public charities. Your 501cs can be anything from a public charity to a country club to a social welfare organization, these sorts of things. So a much broader application to tax-exempt organizations. So just once again, another key reminder with the Paycheck Protection Program, there's been a lot of discussion lately around the fact that IRS and the Small Business Administration are going to audit anybody that received greater than $2 million in loans with respect to this program. The key item behind that is bullet number 2, where it says the principal purpose of the loan is to help employers retain their employees, that you need the money in order to retain employment for your employees. Once again, the eligibility, you go down a little bit, effectively 500, you have to have 500 or less employees. There are some exceptions to that. There's the alternative size standard. There's the NAICS code standard that you can look at. We're not going to get into that today. And then the other key item at the bottom is where I show, if you're a 501c3, you can qualify for this program. A lot of words on this page. The key thing here is in green are the loans forgivable. And yes, they are, as long as you meet certain criteria. The 2 key criteria are the 75% number for payroll, and then also the 25% of the loan can be used for non-payroll type items, pretty much limited to mortgage interest, rent, and a few other items that we'll get into in a little bit. It's over an 8-week period. They have to look at your forgiveness period and the money that you've spent. So we'll get into that. The other thing that came out with the application for forgiveness is what are the documentation requirements. There are a few. We'll touch base on those as well. So what are the highlights? Like I said, last week, May 15th, the Small Business Administration and Treasury issued what they call their first version of the PPP loan forgiveness application. It goes through a variety of different things, gives some additional guidance in the instructions as far as what constitutes qualified expenditures. It does some clarification on the full-time employee equivalent and how you calculate that for purposes of either the reduction or what constitutes an employee to qualify for the payroll component. There's some clarifications around the salary reduction test formula as to what does and doesn't require you to reduce your loan forgiveness with respect to the employees. And then once again, the supporting documentation was also further defined. So let's jump into it. Loan forgiveness application. I didn't pull that together, didn't provide you a copy of that. Gave you a website here at the bottom where you can take a look and see for yourself what it looks like. Pretty involved form. It has a variety of different parts on it, as you see on the screen. The key thing is that you have to submit parts 1 and 2 to your lender. All right, so loan forgiveness calculation, the payroll cost. Once again, the key thing with this, I'm not going to go into great detail. It has to be cash compensation, and you can't have the salary exceed $100,000 prorated for the covered period. So you're looking at an 8-week period. So the max total compensation you can look at is $100,000 for payment, but that would just be the amount that gets paid in that 8-week period. Now you have to remember that there are certain costs that are excluded from this as well. So if you have any employees that are outside of the United States, those payroll costs do not count, nor do any payroll costs you have associated with either of the credits that were allowed under the Families First Coronavirus Response Act. Those, any salaries you have that you got credits for with respect to that, you have to pull those out of this computation as well. The $100,000 or the annual salary component is your gross number. So you do not have to reduce it by any taxes that were withheld from your employees. So it's their gross compensation number. So there's now, with the application, there's 2 ways you can calculate what salary costs get included in that 8-week period. So we have the standard covered period, but now they've also added what they call here the alternative payroll covered period. And we'll get into this in a little bit. What they're trying to do is figure out, okay, if you received your loan proceeds and now you're trying to figure out what your payroll period is, what happens if your payroll period crosses the date that you received your proceeds, and how do you go through and do that? So for example, if you have a regular payroll period under the standard covered period, and let's say you're paying payroll every 2 weeks, you have the dates April 20th, and then you go through and you look at your different, or the date, April 20th is the date you receive the funds, but these other payroll periods are the periods in which your payroll actually is. And then on the alternative covered period, what it allows you to do is use the date you received your funds and move that forward with respect to your payroll period. I have a couple of slides here later. We'll get into that, and I'll show you in graphic form how that works. Why is this? Why did we need this extra piece? Well, the problem is in the language with respect to the loan forgiveness computation and the payroll costs, because the language basically says it's payroll that is paid, or payroll costs that are incurred. And so a number of people got concerned and said, well, does paid mean I have to have it paid by the end of my 8-week period in order to get it to qualify? What does accrued mean? These sorts of things. So how this works, busy slide. How this works is I've laid out a diagram for you that says, okay, if for April 20th, if you look at the box at the very bottom left-hand side of the screen, April 20th is the date you received your proceeds. April 24th is the end of the first payroll period that includes part of April 20th. What you can see is you're going to have 14 days of payroll in that period, but only 5 days will qualify for the 8-week period. And then you have your 42 days, and when you get to the end, you're going to have another period where it ends at June 19th, but you're only going to get 9 days of that, because effectively you're going to get the 56 days for the 8-week period of payroll. When you do the alternative method, instead of having the cutoff at the 5 days, you're going to start at 4/20 and then run through that period. The real issue behind this is, what documentation do you keep? How do you prove out your salary for the prorated days? And then making sure that you get your full 56 days of coverage as an expense in order to get your loan forgiveness. So eligible payroll costs are going to include a couple of different items that are non-cash, so they don't fit within your $100,000 max limit, but they're additional costs that you can take as payroll costs associated with the debt forgiveness. So for instance, on the first one, the employer contributions for employee health insurance. So you get to take those expenses, and if you have an employee that is already paid above $100,000, so you're limited to the $100,000 of cash compensation, you get this in addition to that. So that's a good point. That was something that was very favorable when the frequently asked questions came out with respect to this issue. You also get the contributions to employee retirement plans. The issue here, though, is when do you calculate that? Because usually you look at year end and try to figure out when you're going to calculate those amounts, and how are you going to get to accrue those up? So we're still waiting on some guidance with respect to that. And then finally, you do get any state payments you make, not the income tax withheld, that doesn't count. But if you have unemployment costs or other types of insurance costs associated with employees, you'll get that in addition to your cash compensation. So that's the 75% test. The 25% test then is, what are the non-payroll costs? Basically, it's any interest expense, any rent obligations, and any utility payments that you have during that 8-week period. They have to be incurred during that period. But the nice thing is, as long as you pay the incurred amount by the next billing cycle, those amounts are included. The downside is we don't know if you can prepay any of these costs, and so we're still waiting for guidance on that. With respect to utilities, the key thing here is utilities are defined as electricity, gas, water, transportation, telephone, or internet access. Not sure what transportation is. We're waiting to see what was being thought of when that came through as part of your utilities cost. But lease payments are included, not only your rent, as long as you had a lease in place before February 15th, but also is on personal property. So your copiers and those sorts of things where you may rent them or lease them, you would get to include that cost as well. To determine your full-time equivalency, they went to a 40 hours per week, which makes sense. And there's two methods of calculating your full-time equivalency for purposes of determining whether or not you have a reduction of staff that would reduce the amount of loan forgiveness that you get. So one method is to simply say you take the average number of hours, divide by 40, and then use that number, but not to exceed 1. And then the other method is to say anybody that's over 40 hours a week or equal to 40 hours a week is 1 FTE, whereas anyone under 40 hours is simply a 0.5. So if you have a lot of 0.2s, this is a good thing. If you have a lot of 0.8s, this isn't such a good thing. So this last one came out recently talking about if you have a reduction in staff, which would reduce the amount of loan you get to forgive, what about these different types of situations? And there was a recently frequently asked question that was responded to, and basically it says, to the extent you tried to rehire everybody, but if you gave offers to individuals and they just simply rejected the offer, as long as the offer was at the same level that the person had worked previously, then you don't have to reduce your count by those individuals. Similarly with termination for cause, voluntary resignation, and a voluntary reduction in hours. Be careful with termination for cause, though, that will get looked at closely.
I think what we're hearing here, Larry, is quite a bit on those FT and that documentation, especially the, good faith offer, is just really strong documentation, right? Everyone's going to think a little differently, but that strong documentation is what's going to be most important.
That is correct, and that's so on this slide where it talks about the loan forgiveness documentation. Just as Lori was saying at the very bottom, documentation regarding job offers, refusals, firings for cause, voluntary resignations. You need to maintain those, but you don't have to submit them as part of the application process. But you're going to need to keep them for a while. So make sure that you have all your I's dotted, all your T's crossed. So Lori, I appreciate that interjection there. That was very helpful. And then you can see the loan forgiveness documentation that's going to be needed for payroll, for your full-time employees, the FTE documentation, as well as non-payroll cost documentation you're going to have to be able to show when the mortgage was entered into, when the leases were entered into, to make sure they were before that February 15, 2020 date. Timing. When do I have to apply for forgiveness? So far, there's been no date that's been set as far as when you have to apply. The only thing that has been said is with your lender, if when you apply for loan forgiveness and have all of your information pulled together and all your documentation and you want to submit it, the lender then has 60 days to make a determination as to whether the lender agrees to your calculations and whether the amount of loan forgiveness that you claim is the amount of loan forgiveness that they agree to. So you have to work that through with your lender. Questions we still have, I talked about a couple of these earlier. The number 2 is sort of the big one. There's conflicting language out there as to whether the forgiveness includes both your principal and your interest with respect to the PPP loan, or whether it's just the principal. So we're still waiting to hear on that one as to whether that's going to fall out. And then we talked about the third one that says can you prepay expenses like rent expense or other types of expenses that would fall outside of your 8-week period normally. Can I prepay those and get the benefits for that in my loan forgiveness calculation? Especially if it's going to be related to payroll, can I prepay some of my employees and get the benefit to increase the amount of forgiveness that I'm going to get? And then the last one we also talked. Yep.
One more point of clarification. I know I got this question from somebody, I believe, on this webinar today. The things that we're unclear on, just to make sure, FAQs are being issued all the time. So when we're unclear, it doesn't mean that we'll always be unclear. That's why they continue, we read them right when they come out, but those clarifications are happening real time. So it's not a take a guess, it's a wait and see.
Yeah, exactly. I appreciate that comment, Lori. That is definitely the case. These FAQs, the frequently asked questions, have come out all throughout this period, and we continue to wait for additional ones to come out. And as those decisions are made, we try to get that information out as quickly as possible to our clients. So what happens after loan forgiveness? Well, basically, you end up, if you don't get 100% of your loan forgiven, you're going to have a 2-year loan at a 1% interest rate that you can pay off, and you can prepay it if you want. There's no penalty for prepayment on these loans. So exactly what Lori said. Yeah, keep an eye out for potential legislative updates on some of these issues, especially with respect to the covered period. Congress has been talking about some of the items that have come through here, whether the associated expenses that are paid by the loan that's forgiven, whether they're deductible or not. And we're still waiting on additional guidance from Congress on that. IRS has come out with their thoughts, basically saying it's non-deductible. And then, as Lori was saying, as the frequently asked questions come out, Baker Tilly updates our website as those come out, and you can go to the website here, take a look to see what the new guidance is with respect to that, or you can go to the website and sign up for the emails, and they come out whenever we do an update, and you get an email with a specific update for what's going on. So I'm going to end there on the PPP loans and jump into a couple of the other programs. Trust me, the rest of this will go quicker. The PPP just has so much going on. I wanted to make sure that we touched on those items. The Economic Injury Disaster Loan and Grant Program, talked about this a little bit up front. The key thing is this is a 30-year loan, but the interest rates, not ideal, but okay, 3.75% for businesses, 2 3/4 for nonprofits. Once again, all nonprofits, sorry, are eligible for this, or any nonprofit that's under 501c. Little break. The key thing, another difference here is that if you get a EIDL loan in excess of $200,000, it will require a personal guarantee. A number of my clients aren't real excited about that, so they haven't been real excited with the EIDL program, and there's no forgiveness. So you do have a loan, and you're going to have to carry it for the period of time and pay it back. These loans are available through September 30th. And then after that, the program, the EIDL program, was a program the Small Business Administration has had for a long time. It reverts back to the original program. So the nonprofits will get pulled out of there, and a few other organizations that don't otherwise qualify. Can you apply now? Yes, you can. And then just go to these spots for your application for the EIDL loans. The next item is the employee retention credit. And this is a credit that you can use to offset the FICA employer portion of FICA tax that you pay with respect to your employees. To qualify for this, one, you can't have had a PPP loan. That's off the top. But the two key items is if you have a full or partial suspension of business operations as a result of a government order, or, so it's not an and, it's an or, if you need either one of these, a significant decline in your gross receipts of 50% or more. So for instance, I have country club clients that they're not going to meet the 50% reduction in gross receipts because they continue to collect the dues from the members, but they are going to meet the full or partial suspension of business operations because they were required to shut down. for a while. We couldn't have golf, we couldn't have, any social activities and these sorts of things. So they would qualify on that piece, but not on the reduction in revenues. The credit's 50% of qualified wages from the period March 13th through December 31st of 2020. The key is the maximum you can get for any employee is $5,000. So $10,000 of total compensation, 50%, $10,000, $5,000. And then you have to go through and look at what your qualified wages are with respect to that. The difference, so there's a difference in employee retention credit in that if you have fewer than 100 or fewer employees, you can take the credit against all of your employee wages. So then you get to look at both your employee wages plus any employees that you continue to pay that aren't working. So it's employees that are currently working and employees that are not working but still getting paid. Whereas if you have more than 100 employees, you only get the credit for those employees that are not working but still getting paid. And they don't have to be paid compensation. If you're still paying for their medical insurance, the medical insurance component will qualify for those employees that are no longer working for you and may be furloughed, but you can get the credit for the piece associated with the medical insurance premiums and these sorts of things that you continue to pay for non-working employees. This slide reiterates if you have a PPP loan, no employee retention credit. And then you also have to be careful. This is similar to the other ones, no double dipping. So you can't get double benefit for any credits you get under the paid family medical leave or the emergency paid sick leave, emergency family. And then if you do have the work opportunity tax credit, all of those have to be looked at separately. You can't double dip with the employee retention credit. Last couple items here. One is the payroll tax deferral. You can get a deferral of your employer payroll taxes, the 6.2% FICA that you pay. But it's a deferral. It's like an interest-free loan, so you have to pay back half of it December 31st of 2021 and half in December 31st of 2022. The emergency paid sick leave and family medical leave credits, those came out very early in the process, only available if you have less than 500 employees. Main Street Lending Program is supposed to be available within the next 2 weeks. It's for the next level of employers. So up to 15,000 employees and up to $5 billion of revenue. You can apply for these loans. A lot of strings attached to it. Take a look. We do have an article on our webpage. You can see what's all going on with that and all of the strings that are attached to the Main Street Lending Program. Unemployment issues for nonprofits. So to the extent that you've opted out of the state unemployment insurance program and you're paying your own unemployment costs for those individuals that you laid off, the CARES Act did issue or is going to cover 50% of that cost. The issue is how is your state going to work that through? Federal government has already said that the state has to apply to the feds first. So the state may request you make a full payment first and then get a refund later. It really depends on which state you're in and what they're doing with respect to that. Other funding sources that we've seen, if you are a nonprofit, FEMA has some, you're able to apply to FEMA as a funding of last resort. Otherwise, Health and Human Services, for those of you that are in the healthcare arena, even if you're in behavioral health, or a variety of different healthcare organizations are covered by that. And then finally, many community and corporate foundations, both locally as well as throughout the country, are providing funding to organizations. I provided a website here where you can go to look at all the different foundations, and it's listed by state. So you can take a look at your state. You can see the foundations that are making grants and what their criteria are. So I think at this point, that's where I'm going to stop. Those are the different funding sources that I wanted to present today. And I'm going to turn it over to Lori, and she's going to give you some background on different accounting considerations and what you'd be thinking about from a financial statement perspective.
Thanks, Larry. Tough act to follow. We recommend, and we get a lot of groans, so I'm kind of grateful now to not be able to hear everyone's reaction. But we really recommend tracking these expenses separately. A reminder, all different clients, all different organizations, different sizes, but they have said that they're going to audit all PPP loans greater than 2 million and select other ones. But either way, tracking them separately with maybe an extra GL code, depending on what system you're using, or some sort of way to not be scrambling at the end, it's really best to keep it separate. Whether you'll get audited or not, just when it's time to apply for forgiveness, you wanna make sure. In nonprofits, we don't have typically extraordinary expenses, but there will be different, we've already seen different ways of how these are being accounted for. So just keeping everything separately identifying it, and talking with your accountants and auditors early on to think about what kind of disclosure you're going to need, what kind of balance sheet recording, what kind of footnote disclosure is necessary is really critical. Just a really high level point for the nonprofits with other funding sources besides just senior living resident fees. If you are getting grants, we have some organizations that we work with who are serving underserved people or getting different grants. There's not final guidance on using PPP funds for payroll that's also covered under grant reimbursement. There's pretty consistent feedback that if you're getting cost reimbursed, if Larry works for 20 hours on this program and you get paid for 20 hours of Larry's time, you probably shouldn't also be asked to include, you shouldn't also be including his time in your PPP calculation, because you only need to pay him once for those 20 hours. But even in other grants that have a payroll connection to them, a payroll component, you know, that's in front of the AICPA right now for some clarification. Again, FAQs, frequently asked questions, come out pretty often, but they don't always include everything that was asked in. So that's something to make sure you're considering too. And then the last thing is also, it's a great time to be a standard setter. Also, some conversation for the not-for-profits is this really a loan until it's forgiven, or under some of the new contribution guidance, is this a conditional grant that, hey, I think I'm gonna get to keep this money and have it be forgiven if I meet all the conditions? Again, not a definite answer yet, but those are things to stay tuned for. So the most important thing is to get the money. The second most important thing is to make sure you're tracking and record keeping correctly. But as we kind of exhale after that and start thinking about the accounting and start thinking about audits, especially for 6:30 clients and 9:30 clients that'll be here before you know it, really start thinking about the accounting, because we're seeing a lot of people scrambling, and then doing the untangle later might really be a challenge. Thanks. These are just some of the certain things that we were talking about the grant. I won't go through this whole federal thing, this whole federal guidance, but same thing about the grant. So don't double dip is kind of the theme. You can advance that slide, Larry. And then I think Larry mentioned earlier, I'll echo it again. We have a whole section of our website that you can go directly to. It talks about all the different programs. It talks about forgiveness. It talks about all the FAQs. It's kind of your one-stop shop to keep track of all this. And another warning, if you don't know the answer, it may come out in an FAQ. You don't have to guess, but if you think you know the answer, something different might come up in an FAQ as well. So continuing to stay current, everybody, including the SBA, including the Treasury Department, everyone is figuring this out as they go. So, you know, staying current, it's not that we can learn all there is and then help share that message and teach to others. We think we've learned everything there is, and then something changes, and then it gets modified, and then it gets interpreted. So staying current or asking for help are probably your two best pieces of advice. That's all I have. Blake, do we have questions?
All right, thank you very much. Give me 1 second, and I will pull up the questions tab here.
Thanks, everyone.
I am actually not seeing
Yep,
any
thank you.
questions. So maybe if someone is typing something while they are doing that, I did want to say thank you again to both Lori and Larry and Baker Tilly for being with us today here at the Safe
We
and
appreciate
Home
the opportunity.
Yes, and then we would also like to thank I believe we're in the mid-20s for our participants today that took time out of their busy schedules to join us. We appreciate everything that you guys do each and every day to support your staff and provide quality care to your residents. We are grateful for your continued support, and we are here for you when you need our assistance and resources. Just a quick reminder to check out leadingagemi.org. You can check out the events calendar and see everything else that we have coming up. We do have another COVID-19 webinar tomorrow morning at 10 a.m. with Deanna Mitchell. If anyone is interested in that, you can go ahead and join that. I'm not seeing any other questions come in. So again, thank you very much to both Lori and Larry, and everyone have a great day.
Thanks so
Thank
much.
you very
Thanks,
much.
everyone.